Ever wondered how your credit score is calculated? Well, today, we're going to unravel that mystery. Picture your credit score as your financial report card. It's a 3-digit figure that lenders use to assess how likely you are to repay your debts. This magic number holds immense power. It can influence whether you're approved for a loan, the interest rate you're offered, and even your chances of landing a rental home or a job. So, what's behind these 3 digits? Your credit score is based on several factors, including your payment history, how much you owe, the length of your credit history, the mix of credit types, and recent inquiries for new credit. Just like in school, each factor carries a different weight in determining your overall score. And trust me, there's no extra credit for trying to game the system. They've thought of everything. Now that we've set the stage, let's dive into the factors that influence your credit score. So, what exactly determines your credit score? This is a question that puzzles many, but fret not, we've got the answers right here. Your credit score, that elusive 3-digit number, is influenced by 5 key factors. First up, we have your payment history. This is the big kahuna, accounting for roughly 35% of your total score. It's simple, really. If you pay your bills on time, your score smiles. If you're late, it frowns. So, in the world of credit, punctuality is definitely a virtue. Next, we have credit utilization. This makes up about 30% of your score. Think of it as the ratio of your credit card balance to your credit limit. Here's a pro tip. Keep your utilization under 30%. Why? Because high utilization may make you appear risky to lenders, and nobody wants that. The third factor is the length of your credit history. This accounts for about 15% of your score. It's all about how long you've been borrowing. The longer your history, the better your score. It's like a fine wine, it gets better with age. Now, on to new credit, which holds about 10% of your score. This refers to how many new accounts you've opened or applied for recently. Lenders are wary of borrowers who open lots of new accounts in a short span of time. So remember to take it slow and steady. Lastly, we have credit mix, also representing 10% of your score. This looks at the different types of credit you have, like credit cards, mortgages, or student loans. Variety, as they say, is the spice of life. And it seems this applies to credit too. And there you have it, the 5 factors that influence your credit score. Remember, it's not about perfection, it's about understanding and managing these factors effectively. Understanding these factors is half the battle won. Up next, we delve into the different scoring models. Did you know there's more than one model to calculate your credit score? That's right, folks. Just like there's more than one way to skin a cat, there's more than one way to calculate a credit score, and each of the 3 main credit bureaus, Equifax, Experian, and TransUnion, has its own unique model. Let's start with Equifax. They use a model called Beacon, which ranges from 300 to 850. Beacon takes into account factors like your payment history, the amount of debt you carry, and how long you've had credit. But it also considers the types of credit you have, and how often you apply for new credit. Next up is Experian. Their model is called FICO, or Experian Fair Isaac Risk Model, and it also ranges from 300 to 850. Just like Beacon, FICO considers your payment history, debt levels, length of credit history, types of credit, and new credit applications. Last but not least is TransUnion. They use a model called FICO Classic, or FICO Risk Score Classic. It's a mouthful, but it works pretty much the same way as the other 2. Again, it ranges from 300 to 850, and factors in the same 5 elements. Now you might be wondering, if they're all so similar, why might they show different scores for the same individual? Great question. The answer lies in the data each bureau has access to. Not all lenders report to all 3 bureaus, so the information each one has can vary slightly. And let's not forget, these models are a bit like secret recipes. Each bureau might weigh the ingredients or factors a little differently, so the same information can lead to slightly different results. So you see, each bureau has its own way of calculating. But what about different types of credit? Let's explore. Ever heard of FICO 8, 9, or 10? They're not secret agent codes, I promise. Let's dive into the world of FICO scoring models. FICO, standing for Fair Isaac Corporation, is the big kahuna of credit scoring models, used by a majority of lenders to decide your creditworthiness. Now they have different versions, and it's not just to keep things exciting. Each model has its unique features and is used for different credit types. First off, we have FICO 8. This is the most widely used version. It's like your reliable old pickup truck. It does a good job for most credit decisions and is particularly sensitive to high credit card balances. So if you're maxing out your card every month, FICO 8 will not be your best buddy. Next up, FICO 9. This is like the sleek modern sedan of the FICO world. It's a newer version and has a few updates. For instance, it treats paid-off collections differently and gives less weight to medical debt, so if you've had some hiccups with medical bills, FICO 9 might be a bit more forgiving. Lastly, there's FICO 10, the latest and greatest, like the shiny new electric vehicle on the block. This model takes into account trended data, which means it looks at how you've managed your credit over time, not just a snapshot of your current situation. It's not as widely used yet, but it's gaining traction. Now, for auto and credit card decisions, lenders might use specific versions known as FICO Auto Score and FICO Bank Card Score. These models are fine-tuned to predict risk specifically for auto loans and credit cards. So, if you're planning on financing a new car or applying for a new credit card, these are the scores to keep an eye on. Now that we've unraveled the mystery of FICO scores, let's switch gears to mortgage scoring models. Getting a mortgage? Your credit score matters. It's like the credit world's equivalent of the old real estate mantra, location, location, location. Now let's dive into the mortgage scoring models, specifically models 5, 4, and 2. These are not random numbers drawn from a hat, but rather they refer to the versions of FICO scores that mortgage lenders typically use. FICO Score 5 is employed by Equifax, 4 by TransUnion, and 2 by Experian. This might seem like an odd numbering system, doesn't it? But remember, the credit world has its own unique language. These scores range from 300 to 850, with a higher score indicating a lower risk to lenders. When evaluating your mortgage application, most lenders will pull your scores from all three bureaus and use the middle score to determine your credit worthiness. But what's the difference between these mortgage scores and the regular FICO scores we discussed earlier? Well, the mortgage scores put a heavier emphasis on your payment history on installment loans, particularly mortgages. This makes sense, doesn't it? A lender would want to know how you have handled mortgage payments in the past before lending you a couple of $100,000. Just imagine you're lending money to a friend. You'd want to know if they've paid back their debts in the past, right? It's the same principle. Now here's the kicker. Even if you have a great FICO 8 or 9 score, if your mortgage scores are low, you might find yourself facing higher interest rates or even a flat-out rejection. That's why it's essential to keep a clean credit record across all types of credit, not just your credit cards. And remember, these scores are not set in stone, they are dynamic, changing with your financial behavior. So if your score is low, don't despair. You can always improve it over time with responsible credit usage and timely payments. From buying a car to securing a mortgage, your credit score plays a crucial role. So keep it healthy, keep it high, and open the doors to your financial dreams. So, what do we take away from all this credit score talk? Well, we've journeyed through the world of credit scores, and it's been quite an adventure. We've discovered that these seemingly cryptic numbers hold a lot of power. They're not just digits, they're your financial reputation in the eyes of lenders. We've learned that several factors influence these scores, like payment history, amount of debt, and the length of your credit history. We've also unraveled the mystery of different scoring models. From the 3 credit bureaus models to the various FICO scoring models for auto, credit cards, and even mortgages, we've seen that each has its unique way of evaluating your creditworthiness. And remember, these scores play a crucial role in various financial scenarios, from buying a car to getting a home loan and even renting an apartment. Remember, understanding your credit score is the first step towards financial empowerment. Until next time.